On the agenda tonight, an $8 billion pump and dump scheme in GameStop stock takes retail investors in a roller coaster ride.
Marten, you're up $1 million!
Yes!
And now you've lost it all but $600. You got greedy, Marten.
U.S. retailers warn that the consumer is getting annihilated. With higher inflation and higher rates, is becoming a hoe the only way possible to be able to shop in this economy?
You work on commission, right?
Yes.
Big mistake. Big. Huge. I have to go shopping now.
And this week, all eyes will be on Nvidia's earnings. Make or break for the stock market.
I don't know how much longer I can hold this.
All right. Today is Sunday, the 19th of May. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Let's begin with well wishes to the chairman of the Fed, Jay Powell, after he contracted the thing, triple jabbed, quadruple boosted, but he still got it, so we wish him speedy recovery, because without the printer-in-chief, the country's economy would collapse in 2 seconds max. And folks, I know some of you might feel down, or you're kind of losing hope, life is not fair, etc., etc. Think about the man in Las Vegas who got bitten in the balls 3 times by a scorpion at the Venetian Hotel, and he didn't even get a refund. What a kick in the nut. What I'm trying to say is it could be worse, so be thankful and cheer up, because we got a lot of good stuff here in this program tonight. So buckle up and let's dive right into it. We begin with the first story that we got for you tonight, which is, what else? The meme stock mania, GameStop, pump and dump scheme. We wake up this Monday and we heard the news that the meme stock mania is back. GameStop stock is blasting by 100 gazillion trillion %. Why? Because there's this character online called the Roaring Pussy, and he tweeted something, and that caused the stock to go higher. This is the kind of market functioning that Jay Powell and the SEC and Akoma Ginsler are proud of. We're creating pump and dump schemes using memes now. And folks, if you've been watching this show for a while, you know our take about all of this stupidity. It's shame, really. It's an insult to the evolutionary process of human beings when they portray this as, oh, it's just retail traders versus the man. The poor now beating the rich all of a sudden. And we all know it's a scam created by the rich, the Wall Streeters, the oligarchy, to suck the money away from the dummies and place it in their pockets instead. But they gotta give you a narrative. They gotta give you a story that, oh, you're winning now. Look, the stock went up 100% and you're finding the man, etc., etc. We know in the first episode after the pump and dump in 21 that the man, Ken Griffin of Citadel, actually made the biggest profit in Wall Street history. So at the end of the day, the man wins. All of this stupidity about, oh, the regular guys versus the man, that's bullshit. That's just a marketing scheme by the Wall Streeters themselves. And for all you know, the Roaring Pussy could be an implant working on behest of the oligarchy, if not an intelligence asset. And they decided to pay him to fluff up the stock via a meme, in, out, hello, goodbye. And here in this channel, specifically in Discord, we've been talking about this for a little while. Before the pump happened, we've seen increased volume in GME, the stock of GameStop. We've seen huge call options activities taking place beforehand, meaning somebody was already positioning themselves in anticipation of a pump. Then the pump comes Monday via a tweet, and the insiders, of course, dump. They cash in big, and they sell the retail traders another, oh, this is the comeback of GameStop. They jump in again, pouring billions of dollars, $5 billion in trades. And that's only in Robinhood. And then they short again, and they manipulate, and they do all the whole thing and the usual stuff that they've been doing, and they crash it down, and they get richer in the process. Since peaking this week, GameStop stock down 70%. A lot of folks bought at the top, and now they're hoping and wishing for another miracle. Another meme pump, perhaps? We'll see. We'll talk about that in a minute. Could it come back? That's the important question right now. But hold your horses, because when these pumps happen, it's not just the oligarchy and the insiders and the cheats are dumping. It's also the companies themselves. I mean, these are shitty companies on the verge of bankruptcy. You give them a gift, they'll take it and dump. So you got GameStop on Friday dumping more shares, and they leaked the earnings report and they said, oh my God, sales are down. So what is the reason behind chasing the stock? Why do we have diamond hands? Why are we stupid? And the same goes for the apes. Ape Land, AMC. The moment the stock pumped higher, they said, thank you so much, appreciate it. Let's dump about 23.3 million shares. In, out, hello, goodbye. All in all, the pump and dump scheme cost retail investors about $8 billion. The rich stealing from the poor and the middle class again. This is why we say that being a hoe is the only justice system that we got in this country. It's the only phenomenon when we see the poor taken away from the rich and then giving them chlamydia on top of that. I would say it's revenge. But anyhow, this is the meme that caused the pump in GameStop. The man leaning forward in the chair. Oh, now we got to pay attention. Oh, now it's getting interesting. And then whoops, falls off the chair and game over. Is it game over though? I don't want to leave you with no hope here, but let's talk about how these pumps and dumps happen in a detailed way. So you can see before the pump even happened, the volume was going higher. Lots of call options positioning, which lifted the shares higher. It was trading at about $10 a share. Before the pump, it was at 16, so it was already 60% up before the meme was released. So that's the positioning beforehand, via call options, via buying shares. And those are not retail investors. Those are the insiders behind the pump and dump scheme. Here comes the meme Monday. So the algos, the market maker has to make a decision really fast. They look at the volume pre-market, they look at the options market positioning, and they set a price. So the stock opens big. That's the price that the algos decided that's where they see the options market activities leading them to. Then, of course, comes the retail investors saying, okay, here we go again. We're back. We're so back. And they begin chasing. And then folks pile in and they buy some call options way out of the money, of course, with expectations of a huge pump. This feedback reaches the market maker. And the next day they push it higher because somebody has to buy to cover for all of these call options that they sold. It's called the gamma squeeze. The problem is, and we spotted this in the show, if you watched our show midweek, when the implied volatility reaches extremes, you can spot that by looking at the IV rank, which in GameStop's case reached 100%. What does that mean? It means that the premiums are way too hot. This is the highest implied volatility in a year, and the pricing is out of whack. If you want to buy out of the money call options, you'll pay too much for them, to the point where it's just pure robbery. You're just handing your money to the market maker. It doesn't make sense anymore. It becomes way too expensive. When that happens, what do we see? More insiders dumping. And then we see, of course, a lot of folks piling in, buying put options, now betting that's going to go down. They begin shorting again. This feedback reaches the market maker. And by the way, what made the difference in the top and the reversal is the lack of out-of-the-money call options for the week. So you couldn't get the 90 or the 100 call options. It topped out. I think that was part of why it became a pump and dump scheme. Because the market maker looks at the data that they have and they say, okay, calls topped out. Now I see the flows showing up as puts. A lot of folks buying puts. I get a hedge against that. So they begin selling their shares that they bought during the gamma squeeze. The stock flushes down. And the next day, the put options feedback shows up and the market maker priced the stock price in a gap down. And the stock continues to go down. But now the psychology goes as the following. A lot of the folks who missed the pump, now that the stock is down pretty much closer to Monday pricing, all of a sudden they want to buy. Because what if it goes higher again? I have FOMO. And they buy and we see this sort of a recovery candle. The only problem is, it's not enough to reverse the wave of put options and shorting, and moreover, the news that came from AMC of dumping shares and raising money. So we see the stock opening down in the pre-market session, gapping down again. At that point, a lot of folks say, okay, you know what? What if this is a pump and dump scheme? Let me capture whatever profit I got. Let me get out before my losses expand. We see capitulation. The stock goes down even more. Comes Friday, we get the news that GameStop is indeed issuing more shares, aka dumping. And of course, they release the quarterly earnings, that sales were down. And we see the stock crashing down on Friday's session, but it is also called the climax. Why do we call it that? Because at this point, you got options expiration. Whoever bought the puts with May 17th expiration, well, they got to close that and book the profits. Anybody who shorted closer to the top of the pump, it is safer to say that it is time to cover the short, book some profits. What could be the next step as we see more short covering? It could be that GameStop will pump again. Not as high as it did last week, but it might do some recovery. Might reach 26, 28 again. The problem is if we don't see more enthusiasm, more pumping, more buying of call options out of the money, it's not going to sustain. Because you see two psychological phenomenons. One, the shareholders who've been perhaps holding since 21. And this was the best hope that they got to come back. And it was only a pump and dump scheme. So when the price improves to, let's say, 26, 28, maybe 30, the psychology says they're probably going to dump and get out of this whole thing altogether. And the other problem would be after seeing this pump and dump in a really fast fashion, it's going to discourage a lot of folks from participating in it. And that lack of participation will make whatever pump we get from here limited. Unless, of course, we see a bigger pump, somebody else interferes. Say Elon Musk announces buying shares of GameStop. That could do it and create another big pump, but besides that, I don't see how it can recover from here. And of course, shame on all of us retail investors because we gave Jim Cramer, the opportunity to troll all of us. This is how bad and stupid this whole meme stock mania. Now, folks, when you see these kind of things happening, they're fun to watch. You look at them, but the participation in them, if you're not already in before the pump takes place, there's probably nothing for you to do. Even if you try to short it via put options, the implied volatility will be so high that when the stock finally goes down, the implied volatility drops down with it, and the premiums will shrink in value. So the profits you're going to make will be really limited. And this is why I say it's fun to watch, but you can't really participate. In this channel, we did anyways via a lotto ticket because a lot of you have been saying, hey Maverick, what about GameStop? Should we short now? I'm like, okay, here's a trade for you. This is stupid, because pricing is out of whack, but just in case. Bought the 20 puts, expiration date this Friday, May 17th, and we paid about 60 cents a piece for those. If it drops tomorrow, we take the profits and we go. It dropped, but not enough, so it was a losing trade all the way till Friday. Comes Friday, we closed it for about $100. A lot of you did for $90, $80. Doesn't matter, it's a profit, but it's not, let's say, as big as you've imagined if I told you that GameStop would drop by 70% from the top. And that's the magic of implied volatility. The pricing will always be on the side of the market maker when these squeezes happen. And the best thing you can do is just watch. It's fun to watch, but not participate at all. But was the pump and dump scheme in GameStop stock an indicator that the consumer is getting weaker? Because if the consumer was strong and robust and healthy, as they tell us, then shouldn't we at least have seen the meme stock mania last for, 3 weeks, a month or two at least? Is this an indicator for consumer weakness? Perhaps. But we're not going to use GameStop as an indicator for that. We will look at the actual macro data, and you'll see for yourself because I issue these macro briefs on my Discord for the members, and I go over the details of my commentary about every piece of data we get for the week. Now, what you're going to hear on CNBC and the likes, oh, CPI beat, oh, CPI miss, that's all what they care about. Some douchebag analyst who gave you, or an economist who gave you a target. If it's a beat or a miss, they just judge the data based on that. But no regard at all to the details and what they actually mean for the economy. So let's do that, and let's go over the macro brief that I released on May 16th. Here it is. Now that we have all of the pricing indicators for the week, we are getting a clear picture of inflation in the economy. We begin with the PPI, the Producer Price Index. Monthly increase of 0.5 percentage point, the expectations up 0.3%. So this is a beat, and you saw the market reaction was ugly in the morning, then came the plunge. Why did the plunge come? You gotta look at the details. The yearly increase, 2.2%. The prior rating was 1.8%. So again, PPI, producer prices, are going higher. Core PPI, without the important food and energy and all of that, up 0.4%, expectations 0.2%. So beat, all hot for the inflation picture in the economy. But of course, the market spotted this. If we look at the final demand for goods, up 0.4%, sure, but food down 0.7%. Energy was the biggest contributor, up 2 percentage points. Then you got the final demand for services up 0.6%, trade positive by 0.8%, transportation down 0.6%, and the other category up 0.6% month on month. Here's my commentary. The increase in whole prices for goods came mostly from energy. Given the fact that energy commodities traded down since then, the reading is dismissed. An increase in energy cost for producers will be passed as increases in prices for consumers. The increase in wholesale prices for services is alarming. The trade component is the highest monthly advance since July of 23. The negative reading from food and transportation reflects the weakness in consumer demand. The combination of higher energy and trade inflation with deflation in food and transportation costs is evidence of stagflation in the economy. Can you see it now, Mr. Powell? In other words, what I'm trying to say is, the stock market will dismiss the hotter reading in the PPI because a lot of it came from energy. Then the market looks at the WTI, for example, or Brent. And the futures for crude oil went down since this reading was actually conducted in. So the market would say, sure, PPI came out hotter for last month, but between then and now, those prices went down, so we think the next reading will be more favorable. Here's the problem, though. An increase in energy costs for producers will be passed down to the consumer either way. They paid for it, it's already in, and that's going to be reflected in increases in prices for us consumers in the next few readings. The other problem is if you take core, so forget about energy altogether. Services inflation is actually still going higher. Sure, transportation down, but trade is up big. And that's inflationary. Transportation down is an alarming sign. It shows weakness in the consumer. So when you untangle the web, you peel the onion, you look at the details, you come with a different conclusion than what the talking heads give you. Oh, beat, miss, who gives a shit? What we care about is, what does the data say about the outlook for the economy? Transportation is weak, that's not good for the consumer. But then we have higher energy costs. We have higher trade costs. So the combination of both is stagflationary. Then let's talk about the CPI, aka the CPLI. And of course, the CPLI was leaked 30 minutes before the reading actually came out. So if you're wondering why the stock market pumped significantly higher, it's a lot of manipulation beforehand. But why did the market love this reading? Because when you look at the month-to-month increases, in the month of October, we went down to 0.1%, and everybody thought that, okay, now the next reading might be negative. We know that the Fed is winning against inflation when the readings month-on-month go negative for a few months in a row. You cannot declare victory when you have positive inflation month-on-month, is genius. They looked really good back in October, so the market went significantly higher. That was the bottom. That's when the Fed got emboldened. That's when Powell came out and declared victory against inflation. Of course, November, December came out as 0.2%, but again, it wasn't that big of an increase, and the hope was, okay, in 24 we'll go back negative. What do you know, in 24, we began to see that the trend is reversing back up. Why? Because the Fed psychologically backed off and said, inflation, I'm done here. You may come back. And inflation said, thank you so much, I'm back in. This reading came after a lot of talk about interest rate hikes perhaps back in, and the Fed might have to capitulate, and rate cuts are not going to happen till 25. So we see a little dip. We see a downtrend now, at least month on month. And the market loves that. It gives the market hope that, okay, maybe rate cuts are back on now. But let's look at the details and read the commentary. CPI monthly increase 0.3%, the expectations 0.4%. The yearly increase 3.4%, the prior reading was 3.5%. Core CPI, that's without food and energy, up 3.6%, the previous reading 3.8%. I think that was a major contributor in why the market loved the reading, because it's not just energy, it's core CPI coming down month on month. But again, folks, the devil is always in the details. Is inflation dipping down for the good reasons or the bad ones? One step at a time here, folks. Declining categories month on month. Food at home down 0.2%. Gas utilities down 2.9%. New vehicles down 0.4%. Used cars down 1.4%. All other categories increased month on month, led by gasoline up 2.8%. Apparel. This is a really interesting theme, that apparel prices are coming back up 1.2%, and transportation up 0.9%. Here's my commentary. The market likes this reading not just because it was under expectations, but because the significant monthly increase came from energy costs, and since futures traded down, the market kind of dismisses that. With that being said, natural gas prices rallied since then, which could reverse the monthly decline from this reading in the next one, while services inflation continues to benefit from the disaster in the auto market, where we see demand plummeting because of the pressure of higher rates, which is also increasing delinquencies rates. So again, when we talk about the good reasons, the bad reasons, why is inflation going down? Good reasons or bad reasons? In the auto market, it is for the bad reasons. And unfortunately, the only way to recover the auto market would be rate cuts by the Fed. But that would not happen until the recession has already materialized in the economy, because cutting rates will also reinflate categories that are already problematic and continue to show inflationary trends. This is really important for you to understand. And we'll talk about the icy hot phenomenon in a minute, just to hammer that point. If everything was going down, if the economy was slowing down dramatically in every category, then the answer would be easy. Just cut rates and you have a little bit of a lag, but then we see a recovery in the economy. But when you have the icy hot, with let's say autos really getting crushed, but you have other categories like commodities going higher and getting hotter. You can't cut rates, because the moment you do that, to save the auto sector, you're going to risk more inflation in the hotter categories. Anyhow, needless to say, the consistent drop in car prices will continue to aid taming future inflation readings. Assuming the drop in energy commodities stick until the end of the month, the next reading should be more favorable. When I say favorable, I mean for the stock market, because for now, bad news equals good news because it means rate cuts. That's how the market look at it least right now. Before we assume that this is a positive progress, though, we must understand that the drop in inflation in categories like vehicle prices is happening for the wrong reasons. Combined with sticky shelter, medical, and transportation services, we can see yet another evidence of, here it is, stagflation phenomenon in the economy. Apparel prices are also beginning to reflect the inflation in cotton futures during the 21 episode, because it takes time. Inventories, they have to be exhausted first, and then you're going to have to manufacture new apparel using new cotton that you paid more for. Anyhow, this will become problematic for retailers facing higher input costs but weakening consumers. This, I believe, will be good to drive consumers to shop at discount retailers like Ross. Now, we'll talk more about this phenomenon in a minute. Walmart earnings kind of hammered the point that we see the consumer weakening, but they still got jobs, they still have credit cards, they're going to shop. But they're being choosy and picky where they shop. If a certain retailer becomes really expensive, they're willing to downgrade and shop at a more affordable retailer. And this is why maybe Ross will see the earnings this week. The chart right now may be still holding a bull flag pattern. If the report comes out good, indicating that maybe more volume, more demand showing up. As say middle-class consumers now downgrading to Ross, maybe that'll be good for the stock and it moves higher. And the same goes for TJ Maxx. I mean, that's already playing out the bull flag, another discount retailer that we could see more and more consumers having to resort to shop at, because whatever retailers or stores they used to shop at, the prices are no longer affordable. So this is not going to be good for, let's say, Ralph Lauren. Upper middle class, right? Well, those are downgrading now because they have pressure from higher inflation and higher rates. Maybe Ralph is forming a bear flag pattern on the weekly chart. And it goes down, but we see TJ Maxx doing a lot better. Back to the macro brief, we got the import price index. This is really interesting because it came on the heels of the CPI, when the market assumed that, wait a minute, inflation probably dropping down again. But the leading indicators, PPI and now import price index, saying hold your horses, it doesn't really look good down the line. The monthly advance was 0.9%. The expectations was 0.3%, so a huge beat here. The highest monthly advance in 2 years. Unbelievable. Fuel imports up 2.4%, but non-fuel up 0.7%. So you can say it's all energy, Maverick, but it's not really all energy. Even non-fuel is going higher. So we say while fuel contributed the most to the increase in import prices, non-fuel costs also increased dramatically to register the highest monthly advance since March of 22. It's a huge beat, folks. Even without energy, we are beginning to see the lag impact from the economic recovery in China. When I say recovery, by the way, I don't mean that China's good to go right now. I'm saying maybe the stagnation of the Chinese economy has bottomed, and now we see a little bit of a revival in demand in China, and that's inflationary. Also, Red Sea shipping disruptions, that's beginning to show up. If you look at the details of this report, you can see that Mexico also contributed a huge part of this increase. So we think that the rise in labor wages in Mexico also contributing to higher import prices. The rating also reflects significant increases in industrial and metal products import prices. This will likely make construction and government spending more costly. And perhaps this is why we saw stocks like Martin Marietta MLM dropping big today. So you look at the weekly chart of Martin Marietta. Again, excellent stock. We held it for a while before, but when you look at the chart with negative divergence in the RSI and negative momentum now building up in the MACD indicator, and this is a weekly chart, So it is more significant than the daily or the hourly. Could it be that we have a distribution pattern after this amazing rally, and now we see the stock changing courses and moving down? Because you folks are seeing what's going on, with metals prices going significantly higher, whether we're talking about gold, silver, copper, steel, iron, and with the devaluation of the dollar that at least happened in the aftermath of the CPI reading, those prices are going higher and higher and higher. Even aluminum now, little by little, making a comeback. Not to mention, of course, the tariffs by the Biden administration against China. You put it all together, maybe construction is going to begin to slow down, because the cost will increase. On the other hand, if we look at import prices going higher, then that's going to be good for shipping, at least let's say marine shipping for now, because the feedback reaches them with a lag. So for now, we look at a stock like MATX, Madison, a marine shipper. It looks to my eye as perhaps a cup and handle pattern. It might reach the highs at about 125.34 a share. If you look at another one like Kirby, KEX, the ticker, you look at the weekly chart, it's been on fire. We know that marine shipping prices are going higher, and these companies are benefiting. Maybe a laggard. Catch-up play here could be Star Bulk Carriers, SBLK. Weekly chart looks improving to me. It passed a prior resistance level, 25. So we could see these marine shipping companies outperforming as we continue to see import prices going higher. Even the insurers. Think about Chubb. Berkshire Hathaway buying Chubb, that's the mystery stock that they revealed to us this week. They do a lot of marine shipping insurance, and they're charging an arm and a leg for it. So we see this stock at all-time highs. We go back to the morning brief. Now that we covered pricing indicators, let's cover economic activity indicators. We got retail sales this week. It was, again, the Super Bowl of macro data. Retail sales flat month on month. Expectations up 0.4%. So this is a miss. This is not good. The rating for the previous month was 0.7%, advanced of course. They revised it down to up 0.6%. The biggest gainers in retail sales for the month, gas stations up 3.1%. That's because gasoline prices went higher. Clothing stores up 1.6%. That's again because apparel pricing is going higher again. Appliances, electronics up 1.5%. The decliners, non-store retailers down 1.2%, sporting goods down 0.9%, motor vehicles and parts down 0.8%, and furniture down 0.5%. So you see the tale of two economies here. Gas stations, commodities doing pretty good, getting in the hot category. Clothing stores, apparel, getting hot. But vehicles, furniture, any of these big ticket items, not doing so hot so. Now, before I forget, if we look at the import price index, the annual change, as you can see in red, can you say that we're now seeing reinflation in the economy? Because the readings were negative across 23, even in the first quarter of 24. Now we're getting back to positive readings in the import price index. So again, when we say, hey, where's the inflation, Mr. Powell? Well, here it is. Now, let's go back to retail sales. What is my commentary? The increase in retail sales happened in categories experiencing inflation led by gas stations. With that being said, gas stations went down since, which will lead to softer reading in the next report, which will be a negative for retail sales. On the other hand, this is really important. Memorial Day sales will likely cause retail sales numbers in other categories to recover in the next reading, leading to an advance in the monthly report. That's my assumption, of course. However, the reading is deceiving because by looking into the details, we see further evidence of stagflation. Increases in retail sales are coming from gas stations, apparel, and electronic stores where we see higher prices driven by higher commodities and import prices, while we see consumer behavior shifting to seek discount periods to spend, which is indicative of weakness and pressure from higher prices and higher borrowing rates. Now, when it comes to gas stations, as a consumer, it's a necessity. You got no other choice. You have to fill your tank with gas to go to work. So we see consumers paying for that. That's inflationary. And the same with the apparel prices. If cotton futures went higher, there's nothing you can do. Either the retailer would lose money or you have to pay to buy clothes. Now you look at other items, vehicles, washing machines, mattresses, big ticket items. The consumer waits for discount periods before they buy these items. Again, combination of both. Stagflationary, consumer getting weaker, but inflation is still sticky and going higher. in many other categories. Lastly, we got the Empire State Manufacturing Survey. The headline rating down 1.3 points, minus 15.6. The rating last month was minus 14.3. So still in a recession category, and it's getting worse. We look at the forward indicators. Business conditions down 2.2 points. New orders down 0.2 points. Shipments down 0.9 points. But prices paid up 1 point, and prices received, this is really stunning, down 5 points. What do we make of all of this? This indicator is still pointing out toward the recession in manufacturing activities in the economy. What is notable is the contrast between the outlook for prices paid and prices received, which manufacturers expect to pay more but receive less from consumers. The weakening consumer again. This is indicative of weakness in the economy, but also an upcoming increase in unemployment in the manufacturing sector because margins will decline if this outlook holds true. You pay more, but you can't charge the consumer. The only remedy is you get rid of employees. So again, when you read the headlines by the talking heads in the Wall Street Journal or CNBC and the likes, they will tell you that the economy is on fire because some reading beats some jerk-off economist expectations. But they'll never dig down in the details and interpret the data the way I do. And folks, to add more color, let's play some icy hot here. Let's go back to the icy hot phenomenon, which, by the way, I think I deserve a Nobel Prize in economics. I mean, they gave that jerk-off Paul Krugman a Nobel Prize for nothing. Might as well just get it, because one day we'll look back on why the Federal Reserve failed to combat inflation and why we ended up in a recession, a big one. We'll look back to the icy hot phenomenon and the failure of the Fed policy to drive the economy from inflation to deflation without going into a recession. When we do the icy hot, we know that manufacturing, as you've seen in the Empire State Survey, that's icy. That's been icy for a long time. When you look at services, whether we looked at the PPI or the services PMI, we know that services are still hot, hot, hot. You look at any medical services, for example, pricing going higher and higher and higher. Elderly care, child care, many other services are just exploding in pricing, so services hot. What else is hot? Housing is still hot, but moving closer to the icy category. For example, this week we got Home Builders Confidence Index. And the headline reads, builders are slashing home prices to keep buyers interested as confidence in the market wanes for the first time since November of 2023. So again, when we talk about inflation going down for the good reasons or the bad reasons, here's one for the bad reasons. But again, housing moving away from the hot, but not quite icy yet. Then we have construction. I would place it closer to the housing placement, but maybe a little closer to the icy category. Moving away from the hot to the icy. Why? The increase in metals prices and building material prices from the import price index, that's going to make construction more expensive. Number one. Number two, we got data just from a few weeks ago. The biggest 1 month decline in employment in construction in history. But on the other hand, we have the government spending like a drunken sailor. They want to build all of these chip manufacturing facilities. So you take all of this input, we think that construction is still hot, but it's moving away from being super hot closer to the icy category. How about shipping? It's the same thing. Was really hot, now getting cooler a little bit, but with all of the geopolitics and higher insurance rates, we see that shipping prices are still holding. And then you look at commodities. Used to be icy in 23 and late 22, now becoming hot again. Sure, we have cocoa pricing peaking, we have coffee prices peaking, but you look at metals, that's coming back. You look at grains coming back. Meat's been hot for a while. You have oil. Sure, we got a correction recently, but it appears that we're coming back up. You have a recovery in natural gas prices now. With the devaluation of the dollar, we think that commodities will still be hot. Then we have insurance rates, and those are hot, hot, hot. Hot as they get. Just pull up a chart of Progressive, whether we're talking about auto insurance or Chubb or any insurance company, AIG, on fire. So these stocks tell the story that insurance rates are way too high. This is a necessity. You're going to pay for it and shut up. Whether we're talking about home insurance, auto insurance, any kind of insurance. Rates are skyrocketing. You got no other choice but to pay. Labor cost. That's still hot, softening a little bit when we look at wage data, but it's still hot. It is still costly to hire more employees. When we talk about apparel, used to be icy, now moving to the hot category, as we've seen from data in the import price index and the CPI. If we look at other categories, travel, I would say it is between, because if you look at the CPI, airfare ticket prices went down. And again, anecdotal evidence, but I've been doing a lot of travel recently for medical reasons. And the airports were empty, the planes were half full. I don't know if that's just my experience or you're seeing it too. On the other hand, we see that the affluent consumer, be it the seniors taking cruises, or the data from Amex that the business class consumer is still traveling and paying. So we can say that because of that, it is between the hot and the icy, but certainly moved away from being hot. It was way too hot in 23. Now it's coming back closer in between. I would say food is the same thing. Was really, really hot, now cooling off. You see the data in the PPI, you see the data in the CPI, that food prices cooling down a bit. Now retail, I would say still in the icy, moving a little toward the hot, depending on what you look at. We'll do the analysis for retail in a minute. So we'll show you which type of consumer is keeping retail hot and which type of consumers pushing retail to the icy category. Autos, way too icy. Anybody in the auto industry and the viewers today can tell us in the comment section that the demand is getting weaker, financing costs are way too high, and even the dealers now being really picky. They're only accumulating inventory based on what they think will sell. They're not just grabbing whatever inventory they can get, as we've seen back in 2020, 21, and even all the way to 23. What about trucking? I would say it is still in the icy, maybe moving even more to the icy category. Just look at the performances of stocks like JB Hunt and Old Dominion. Old Dominion crashed. We see that hiring for truckers is actually slowing down. So we have indicators showing that trucking is becoming icy. But the next category could be a sign of revival in trucking costs moving higher, which is goods inflation. We talked about the import price index. We talked about the rise in commodities prices. That's going to cause goods to become more expensive, move away from the icy. And that could revive pricing for trucking. And again, if we look at the flows, you see housing, construction, labor, travel, food, retail, trucking, all moving toward the icy. But then you have shipping, commodities, apparel, goods moving to the hot. And of course, we got services and insurance still way too hot. We can do more categories, folks, but this is just an illustration for you that the current policy by the Fed is not aggressive enough to take everything down to the icy, which is how you defeat inflation. And it's also aggressive enough for certain categories, like manufacturing, like autos, like commercial real estate, which you don't see right here. What does that mean? It means that we are in stagflation, at least a stagflationary phenomenon. And for the Fed to defeat inflation, they have to ramp up the pressure in all categories to push services, insurance, apparel, commodities, shipping, everything down to the icy. The problem is what happens to commercial real estate? What happens to auto loans? What happens to manufacturing if you ramp up the heat? The answer is we could see a disaster, a blow up, something breaking down in these really icy categories. That's the challenge that we're in this economy, folks. And it doesn't stop with just economic sectors. If we look at the consumer, we know that the poor is in the icy category and the affluent consumer is in the hot category. You might say, but Marvik, duh, of course. The affluent is hot, the poor is icy. This is always what it's been like. You'd be mistaken. In the year 2020-21, the poor was actually hot. The affluent was icy. Why? Because the poor consumer becomes hot when we have stimulus, when we have aid packages, we have free cash all over the place. The affluent consumer becomes hot when we see the stock market moving higher. So for now, we see no stimulus. The savings rates are plummeting, disposable income plummeting, so we see the poor and the icy. Affluent doing better than ever before. Stock market all-time highs. Real estate values for the affluent consumer, all-time highs. The money that they have in fixed income now actually gaining more because of higher rates. How do you stop the affluent consumer? There's no way you can do that without a market crash. And the affluent consumer is driving a lot of inflation in the economy. We'll talk about that in a minute. But middle class getting a little icy, but the middle class still has jobs, credit cards, so they continue to spend, but they're being choosy and picky in downgrading from one store to another based on the deals. The most interesting phenomenon is the upper middle class consumer. Think about workers in the healthcare sector and the technology sector. They're now downgrading in a big way, and that's not a good sign for the economy. We know that because Walmart reported earnings this week. And here's the headline: Walmart sales surge as wealthier shoppers flock to retailers. So when we talk about wealthier shoppers, we're not talking about the affluent consumer. They have their own shops. They're never going to downgrade to Walmart. But we're talking about upper end, upper middle class consumer. They can't shop at the fancy stores anymore. It's a little more expensive, so they're looking for deals at Walmart. Now the poor, the middle class consumer who's shopping at Walmart, maybe some will downgrade the even cheaper retailers like the dollar stores. But for the most part, Walmart pricing is really competitive. So Walmart as a retailer experiences an increase in volume of sales. Your core consumer is still here, but now you have another consumer joining and consuming at your store. That's the upper middle class consumer. So all in all, it's a positive for Walmart. Now, Walmart stock goes up by 5-6%. What is that good for? It's good for the affluent consumer who owns Walmart stock. When they see their stock going higher, they're spending more, and that keeps inflation sticky. Another indicator of the upper middle class getting weaker. Perhaps a lot of them, by the way, losing jobs to AI. I mean, they're creating AI and they're losing to it. When I think about a brand like Burberry, sure, upscale, got it. Luxury, understand. But does the super affluent consumer shops at Burberry? Maybe they buy some here and some there. But when I think about a store like this, it's the middle class, the upper middle class, who want to look rich. They shop at these stores. Well, last year we know that shares down 9% because sales are down. And this week we got even more bad news from Burberry, which is, by the way, following Gucci. All expensive crap, overpriced shit, really. But again, who shops at these stores? It's not really the affluent consumer as you might think. It's the aspirational consumer, and they cannot afford this anymore. So these stores are experiencing slower sales. Now, when we look at the affluent consumer, the super rich, you got to look at a store like Cartier. You're not going to find the upper middle class or the middle class shopping there. That's the super rich, the oligarchy. And those sales are doing hotter than ever before. A little slowdown in Asia Pacific because of China, but other than that, the affluent consumer is doing better than ever before. So anything that caters to the super rich is doing better than ever before. Lamborghini, running out of inventory. Rolls-Royce, good luck finding one, even if you can afford it. It's boom times for the super rich because the Federal Reserve designed the economy to perform this way. Because the Federal Reserve main mandate is to prop up the stock market and real estate valuations. Well, gee, that works for the rich. Doesn't work out pretty good for the middle class. The upper middle class, certainly not the poor. We see shoppers taking on credit card debt to buy groceries. They say that this is a canary in the coal mine for the upcoming recession, perhaps a depression. Because this time around, when you think about the financial crisis in 08, 09, we didn't see this massive amount of debt happening, $2 trillion plus, and now interest rates are higher. And who knows what's going to happen with commodities prices? They might stick, and rates will stay relatively higher, and that will be a big problem for the consumer. I mean, we're now using credit cards to buy food, the necessities. And I shared this on Twitter. Company after company after company warning that the consumer is getting weaker. From Starbucks to Kraft Heinz to Yum Brands to PepsiCo to General Mills to DoorDash to Shake Shack to Uber to Etsy to Shopify to Lululemon. Everybody's warning that there's something going on with the American consumer. But all you hear by the talking heads in CNBC and the business news media is the economy is robust, the consumer is healthy, doing better than ever before, yada, yada, yada. Even beauty products, Ulta Beauty, stock crashed because demand for beauty products slowing down. We can't even afford to look pretty anymore. This week we got Home Depot showing signs of consumer pullback. Red Lobster is now all of a sudden closing dozens of restaurants all over the country. Why? Because we see fast casual dining is plummeting. And this is data from New York and New Jersey, but it is indicative for the rest of the nation. The consumer is now pulling back. It's beginning to hurt now. Higher rates, inflation for, 3-4 years now? That's going to show up. We look at small business rent delinquencies. Main Street America. When we talk about the tale of two economies, Wall Street, the affluent consumer, the super luxury stores, doing better than ever before. When you look at small businesses' rent delinquencies, surging higher. 43% said they were not able to pay on time. And here's a really interesting article by CNBC, for all people, but it really hammers the point. Some consumers are punting big purchases like pools and mattresses. I went mattress shopping, by the way, yesterday. Memorial Day deals. If you want to get a decent mattress, and we're not talking about the upper, higher end, super insane, it'll cost you about, let's say, $4 to $5 grand. That's insane. Who can afford blowing up $5 grand for a mattress, even if you need one in this economy? So here's what we see. The consumer's purchasing power is limited. Sleep Number CEO Shelley Ibach told analysts late last month. As a result, consumers continue to scrutinize their spending and make near-term decisions based primarily on need, price, and perceived value. And they're deferring higher-ticket durable purchases. The CEO said that the mattress industry is in a historic recession, quote-unquote, with sales likely to continue to decline after 2 already tough years, so mattresses is in the icy category. Although I talked to the guy in the store yesterday, And he said that sales are hotter than ever before in this part of town in Las Vegas. Why? Because Californians moving in, they're dumping their homes in California, getting top prices for them. So when they move here to Las Vegas, they can afford to buy mattresses and pay top dollars on them. So again, it depends on where you look at. We can look at another category of the consumer, the transient consumer, who's moving from one state to the other. Those are still hot because they're moving from states or cities with higher home pricing, San Francisco, Los Angeles, San Diego, even Austin now, seeing folks moving out, New York. And they're moving to smaller cities, more affordable housing, so they can have more disposable income and they can buy mattresses. Anyhow, the Minneapolis-based company lost more per share and recorded lower revenue than analysts polled by a fact sheet. Who gives a shit? Anyways, Wayfair, the furniture e-commerce platform popular among cost-conscious shoppers, said it was having trouble selling more expensive items. Management cautioned that it was a trend happening across the board with home furnitures. Whirlpool cited hiked interest levels as a negative pressure on both housing affordability and discretionary spending, which are both factors for consumers considering appliances like refrigerators or washers. North American volumes were soft in the quarter, and company continued leaning toward promotions to buoy demand, according to the CEO. And this is why, comes Friday, I decided to dump Whirlpool. There was a little hope that housing mania will come back, and we might see demand coming back for washing machines. But when you read this commentary, when you see the trends from other retailers, I'm sorry, but the hope is gone. I think the consumer is collapsing. Now listen to this. This is the most important part. Economic uncertainty and borrowing levels have both, quote, weighted heavily, end quote, on new swimming pool purchases, according to Pool Corp CEO. But, and this is the most important part, but there is a clear disconnect among income cohorts. He said lower-end pools remain a challenge, while the pricier options have steady demand. You see what's going on here, folks? It's the icy hot phenomenon, even among the consumers. Here's more evidence for you. Generac power generators are generally considered a luxury of the financially well-off. Because of that, lifted interest rates likely have not hit its clients as hard, and any impact has likely already been felt with levels raised for several months, according to the CEO of the company. With all of that, folks, what is the conclusion here? The conclusion, you have this great divide, the tale of two economies, and the end product of all of that is stagflation. Now the Fed has a choice to make. What do? You back off to recover the damage that's already been done, and you risk more inflation to come, or stay in the course, add more pressure on the economy to hope that the affluent consumer and the hotter categories will cool down. The problem is, as we said repeatedly, to cool down the affluent consumer and the hotter categories in the economy, you need a stock market crash. It won't happen without it. You need to damage the wealth effect in the economy. That's the only way to cool the affluent consumer, historically speaking. And of course, the Federal Reserve, you got Atlanta Fed zombie Bostic. He says, I don't see a recession. He's going to wait till the recession actually happens. The depression actually happens. And then he says, yeah, I see the recession now. Mr. Bostic, your job is to look forward. Your job is to see what's going to happen. Not leave it to a YouTuber doing a financial show from his garage to see that happening. You and Powell and everybody, you don't see the stagger deflation. Please share this video. Maybe Mr. Powell will, in his illness right now, he's taking time off, staying at home. Maybe he'll watch the show. And maybe he will be able to see the stag and deflation in the economy. And by the way, all of this connects with what we discussed last week, with the outperformance of utilities versus the stock market, which, by the way, still holds. Not only utilities now beating the stock market, consumer staples. Think about companies like General Mills and Conagra and PepsiCo, now also beating the market. All defensive sectors, indicative of a recession in the economy. Of course, we can throw cold water on that because what about financials? The explanation of that is the affluent consumer. We'll talk about that in a minute. But you can also say, what about energy? What about metals? The hottest two sectors in Friday's session. I would say it adds to the evidence. We have a cohort of investors who are looking at the stagflation phenomenon, coming up with the conclusion that, you know what, at the end of the day, sure, we're going to get rate cuts, but they're going to happen for the wrong reasons. So I'm going to position myself right now in utilities and staples in preparation of that. There's another cohort of consumers, of course, say, nope. Maybe that's going to happen down the line, but the immediate effect will be the dollar goes down and you see commodities coming back up. We see metals, oil coming back up and causing more inflation. And of course, more inflation right now increases the probability of a recession later. So both have a point, but the outperformance of utilities is always interesting because usually precedes bad times in the economy and bad times in the market. Now, let's take what we just covered here, and it was plenty, and tie it up to the stock market. The Dow Jones Industrial Average reached 40,000 points. And of course, we're supposed to jerk off to that. The media, ABC, NBC, CBC, all of them, all of the three letters networks, saying the Dow at 40,000, and you have folks jerking off because their 401k is doing pretty good. I would say don't count your chickens yet, because unless you're going to retire tomorrow, it means nothing. It should scare you more that your 401k is going crazy. It means that we are in a bubble right now, and by the time you retire, the bubble would pop. It'd be in a recession or a stagnation, and that'll be bad for you by the time you retire. When we look at the components that led the Dow Jones to reach 40,000, believe it or not, sure, we got the AI mania companies like Microsoft, but it came from Goldman Sachs and companies like Amex. So if you look at Amex, American Express, the ticker AXP, monthly chart, vertical rally with not even a single red candle for months now. Why? The affluent consumer. They keep spending. They're doing better than ever before. So Amex doing better than ever before. Goldman Sachs, better than ever before. All-time highs. Why? Affluent consumer. Stock market doing better than ever before. So we see Goldman Sachs going higher. It all ties in, folks. The tale of two economies. But underneath it all, the warning signs are here, because the middle-class consumer, the upper middle class, those are the heart and the backbone of the economy. If they begin to feel the pain, they're going to spend less. This feedback will reach companies' earnings. When that happens, stocks go down, and then the affluent consumer is hurt. But for now, when we talk about the stock market, it only cares about two things: the prospects of rate cuts and AI. And if you have both of them being active, the stock market goes bananas. No corrections, no drops, not a single red candle. When you have one down but the other up, you see the stock market maybe stalling a little bit, slightly positive, but not as crazy as when both of them are active. When both of them are not active, we see sharp drops. Think about a few weeks ago when we were talking about rate hikes, and we got earnings from ASML, Super Microcomputer, and AMD, and all of these reports were disappointing. All of a sudden, both items were off. And we've seen a sharp drop in the stock market. Then came Powell, and he talked about, I don't see the hikes, I don't see the stagflation, and the cuts are on the table again. Then comes the CPI as a confirmation of that, at least for now. And we see rate cuts being active as a market pumper. And then, of course, you have AI. You can damage that a little bit by smaller companies like AMD, like Supermicro. But then you have Microsoft spending, you have Alphabet spending, and the big kahuna, Nvidia. We did not get the report yet. So all of a sudden, the market decides, you know what, AI is back on. And both of them are active now, and we see the stock market just surging higher. But this week will be pivotal, folks. When we talk about rate cuts, sure, we got some Fed zombies like Governor Bowman, for example, saying that, hey, rate hikes, if needed, I'll go with it. You got the zombie from Minneapolis, Kashkari, saying the same thing. But at the end of the day, the big dog, Powell, that's what matters. And Powell is controlled by Yellen, and Yellen doesn't want a single rate hike. She wants rate cuts ASAP. But she's also conscious that if she does that, it might lead to higher inflation before the elections. And Powell, of course, conscious that if he does it, it might look political as we hit closer to the election season. And I think Powell this week was clear. He said that the policy will be hold. We'll hold and then see what happens. Now, what does that mean? It means that the market will look at it as, okay, you know what? Rate cuts will happen, but maybe further down the line. Rate hikes, the door is slammed shut. Bowman and Kashkari can say whatever they want, unless we see a significant piece of data, such as oil at 100, or a massive surge in, let's say, grains prices again. We're probably not going to see rate hikes. So the market says, okay, sigh of relief, the rate cut optimism still active. And the illustration of that, and it's going to lead to the next point, AI. I told my members this week that what matters really in the stock market is the dollar. When we see the dollar trending down, you got to be bullish the stock market. When the dollar is trending up, you got to be bearish the stock market. But we gave you just a simple illustration here from the chart. And if you tie it up to the RSP, which is the equal weight S&P 500, you'll see that the indicator is accurate. When the dollar is trending down, we see the stock market moving higher. When the dollar is trending up, we see the stock market going down, except for the first period that you see, Jan to February. The market was actually up along with the dollar. Why did that happen? The answer is Nvidia. It was the Pelosi rally in the beginning of the year, and that hammers the next point. That sure, rate cuts, why was the dollar going higher, by the way, from Jan to February? The data was not as friendly. And now we're talking about, rate cuts are not going to happen by March, by May, etc., etc. But Nvidia going higher was good enough to overshadow the fact that the prospects of rate cuts were less active. That tells us right away that AI is perhaps more important. When we say AI, folks, we're talking about Nvidia. Nvidia is more important to the stock market than rate cuts right now. And if Nvidia goes down, everything goes down with it. Specifically, if we have rate cuts off the table again. What do we have this week? we have Nvidia's earnings for the quarter. Make or break. Some leading indicators, you have investors like Stanley Druckenmiller. He dumped his shares. I mean, it's really smart because he rode the bubble, he made money from it, and he dumped pretty much at the top, assuming that it's going to be at the top. Now, just because he dumped doesn't mean that the stock is going to go down, but you got to consider that. Why do we have a smart investor like Stanley dumping Nvidia right now? If Nvidia goes down, ladies and gentlemen, it's going to be a major, major problem for the stock market because you need rate cuts at that point. Otherwise, down we go. Now, folks, this was a really good conversation, but it took a lot of time. And I'm trying to keep the videos as short as I can because I know that the average attention span out there is for mice. So we're going to have to skip the data of the stock market and just move to certain charts that I want to show you. And then we're just going to wrap it up right there. We begin with the weekly chart for the SPX, the S&P 500. We know that this week, 5,300 was the most important level. It was really active for the market maker. That's the short-term impact, of course. Got a correction, reached the 20 weeks moving average, got a rebound. We're back at the highs again. Here's the problem, though. The divergences. We have a higher high in the stock market, but we still have negative divergence in the relative strength index, the RSI. Why is this important? So I'm going to enlarge this for you so you can see it. Negative divergence, at least for now. And the likelihood is, since the previous high was out of whack, the likelihood is you're not going to beat it. The probabilities say that the relative strength index will actually roll over before making a higher high. When did we see that before? When the market makes higher highs, but the RSI makes a lower high in the RSI. Negative divergence. On the weekly charts, not the daily. Weekly is what matters. Let's go back. The financial crisis 2007-2008. You see the positive divergence that we see in the stock market making higher highs, while the RSI making negative divergence. Well, gee, that was the top. And after that, the stock market crashed by 55% plus. We're also seeing this phenomenon back in 2014. Market making higher highs, but the RSI in the weekly chart making lower highs, negative divergence, and that led to a correction of about 6% or so. So this is more benign than the previous example. We saw it again in 2014. We got a correction out of it. So usually it leads to something bad happening as a correction or even worse. In the next example, we have higher highs in the weekly chart of the SPX. This is 2018. You got the volume getting crashed. Then we got a recovery making a higher high, but the RSI made a lower high. And after that came the flush down in the fourth quarter of 2018. The stock market went down by more than 20%. We've seen this again before the COVID crash, when the stock market made higher highs, but the RSI made a lower high. And we've seen the COVID crash worth about, let's say, 35% or so. We've seen it again in 21. When the market made higher highs, but the RSI was in negative divergence. And after that came the bear market and went down by about, let's say, 25% plus. Now we see it again. Higher highs in the market, but negative divergence. What would it lead to? Another round of correction or something worse? I think it all depends on Nvidia. If Nvidia goes down, I think we're going to have the top. And I'm talking about the top. We're going to begin to decline from this point on. This makes it a pivotal week. So all eyes will be in Nvidia. And again, I made a lot of charts. I prepared for this show, but it's going to take us for another half an hour or so. Unfortunately, we got to cut it short here, folks, and move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, the 20th, we have a bunch of Fed zombies speaking, from Vice Chair Michael Barr to Christopher Waller to Vice Chair Jefferson. And Tuesday, the 21st, we have more Fed zombies speaking, from Waller again, New York Fed zombie Williams. And then we have the Chair of Supervision, once again, Michael Barr. After that comes more zombies from Cleveland, from Atlanta, from Boston. Of course, this is all what they do, just travel the country, tour the country for speeches, courtesy of the taxpayer, and private jets, of course. Then Wednesday, the 22nd, we have Nvidia's earnings. That's the most important event, but macro-wise, we got existing home sales and the Fed minutes from the last FOMC meeting. Thursday, the 23rd, we have initial jobless claims, the services and manufacturing PMIs, also known as the flash PMI. Then we got new home sales and another speech by Fed zombie from Atlanta Bostic. And lastly, Friday, the 24th, we have durable good orders, and then we have consumer sentiment, the final reading. And before that comes another speech by Fed zombie Christopher Waller. And folks, once again, lots of information that were not included in this show because we ran out of time. But I'm going to cover more in tomorrow's video for the members. So please, if this video was informative to you, give us a like, subscribe, leave us a nice comment, and consider being a member here on YouTube, or better yet on Patreon, where you can access the daily show. Links in the description. But with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and happy 60th anniversary for Viva Las Vegas. And good night.
There comes a time in a man's life when he must put away his toys and get on to the more serious business of living.
Definitely.
I agree with you, thoroughly. And it's a pleasure to hear a man's opinion, and not have to listen to the stubborn ravings of a boy who won't grow up and